Hi, everyone. I'm Dr. Fasanya. I'm a pulmonary critical care physician, CEO for Dr. Breathe Easy Capital. And I have my co-host, Dr. George Ozoude, orthopedic surgeon. Yep, he also has a real estate syndication company, a real asset syndication company called Time Health Capital. He's the CEO. So today we have something a little bit different. So this is very interactive. And if you have a question, just raise your hand or you can type it in the comment. So we're going to be talking on some legal ramifications of real estate syndication. Basically, we want to talk about all the documents that you need to know about, which one of them, it's bound you to the deal, the definitions of some key terms in real estate syndication. And we have just compiled the most commonly asked questions that we get from investors. So many investors ask us different questions. After all, it turned out to be the same series of questions. So we're going to just keep it light. And if you have questions, let us know. Let Judge.
Yep, I'll take it from here. Yes, we definitely encourage questions. We're going to go through what you would expect to see as an LP, starting from the initial contact that you would get from a GP, like what the first things that you would expect to see when a deal is offered. And then we'll go through each of the documents that you'll come across, and we'll talk about different points along the way for each of them. So I'm going to share my screen here. So I got my email open. I'm going to actually pull up a sample deal that I've got. This was back in September of last year. So the initial document or content that you will receive when a GP has a deal is very likely going to be an email that shows something called a one sheet. And this is what it is. In the email, you get this kind of graphic, this little information sheet that's high level, 30,000 foot view. What the goal is to give you just the idea of what the deal is, what the asset class is, and some general numbers to test and see whether you are interested in it or not. There's a lot of other documents that we're going to see for the rest of this hour. These GPs don't want to bombard you with all these documents if it's not even something as an asset class that you're interested in. So the very first thing you expect to see is this one sheet, very high level. So here we see NHK's Capital Group. They're making a new investment offering. They give you the location. This is Conroe, Texas. They showed you some very high level return profiles. So they show you the equity multiple over the time frame, which is 3 years. They show you the target IRR and the minimal investment, just to give you broad information about what you might use to decide if you even want to click to learn more, right? That's what the importance of this sheet is. So they'll show you who they are. You'll get the name of the company. You'll see some faces, some names, some titles, just to put some personal touch to this sheet. But in order to learn more, you have to click. So beyond this, there's nothing else. It's at this time you decide whether this is something you're interested in or not. Do I want to invest in a development, or do I want to invest in farmland? If I want in farmland, then I can just close out and delete this email because this is not even in my radar, right? But if this is something that is in your radar, okay, I want development, I want Texas, I like these returns, I'm curious, I don't know yet, I want to learn more. I've never heard of these guys before. So you click on learn more. And so once you do that, what you're going to do is likely get into a webinar. So you'll sign up for their webinar. Once you go through their webinar, they'll actually give you 2 forms to either see the webinar or review it. So you can actually sit in on the live webinar. And of course, there's going to be a recording. And if you get the recording, you'll get a file like this in another email where you can literally replay the webinar if you missed it. But if it's something that you actually sat in on, then you get the experience live. But the other way you get this is in the form of something called a slide deck or offering memorandum. It's called the OM. So these are key terms that you can see and start to hear when you're in these spaces. Something called the OM equal to the offering memorandum, aka the slide deck. And this is just the webinar that they presented in slide deck form. like more in-depth overview. This is not a legal document yet. This is just a presentation. So they'll have a bunch of disclaimers on it. Usually the first things that they talk about is who they are. They need to qualify themselves. So you need to, first assess and evaluate and look through who the operators are, who the sponsors are. So they tell you a little bit about themselves. They share their track record, what deals they've done, what gives them the credibility, the subject matter expert title, right? So that's their track record. That's the general partner. Then they talk about the market and the asset class and why they're interested in it. And so you'll get high level information about different types of reasons why they go into this asset class. Is it growth oriented? Is it trending? Is it where the puck is going? Information like that. A lot about the market. They'll talk about the area regarding the market. So here they're looking at the location. It's in Houston, the north suburb of Houston. And so you'll get information about why the market is attractive. And then you'll see even more like information about like job, economic activity, population growth, the high level things that we talk about in our coaching program as an LP, what things you have to key in on when you're assessing the market. They'll talk about the sub-market specifically, the demand in that area. They talk about other economic activity in the area, so other businesses and establishments. Then they'll talk about the deal itself. You'll look at the specifics of the deal. How big is it? When's the timeline? Like how far out there are they projecting for it to be built out? Specific numbers about the square footage, how much they're paying for the square footage, how much their build costs are going to be. Still high level, but information that you might need to make a decision on whether you like this property or not, this project or not. Unit mix they'll talk about community amenities, things that are about the deal itself specifically that might make it attractive. So again, more sub-market stuff, looking at more macroeconomics, looking at rental comps to compel you if this is a good deal or not. They'll give you a timeline of when they expect things to play out, particularly like when construction's going to start, when they're going to get your initial occupancy up, when they're going to complete construction, when they expect to stabilize, and when they expect to exit. Then you'll see actual underwriting. Sometimes you may see like just a snippet like this, or sometimes they may give you the entire underwriting. Either way, you can ask for the entire underwriting, and most operators will be willing to give you that. So you can actually look at the numbers and crunch them the way they presented and see if this is something that you agree with the assumptions that they made in the underwriting. Then they'll explain the return profile. They'll look at the different types of waterfalls, if that's their structure. And this is something that you saw with the one sheet, but it goes again into a little bit more detail. What does the actual waterfall structure look like? More in-depth, spreadsheet information about these returns. That'll usually be in this offering memorandum as well. Then they'll do a summary and give you the option to either do a one-on-one call with them to ask a little bit more information, or if you're ready, then you'll go to an email that says, I'm ready to invest, and they'll give you now the official legal documents. And I'll kick that over to Bio so he can talk about the official legal documents that you would see. Any questions about that before we kick to Bio? This is the offering memorandum and the one sheet. Okay, Bio, we'll kick to you. I'll stop share.
So let me use, good, okay. First, we can actually just talk in general about all the kind of documents that you see, right? So let me just get it. So I'm just gonna share them. Just that screen. So that's not the one there. Before we go to the PPM, since I already have this open, this is just the accreditation letter. Just because people constantly ask us about it, how do I get accredited? Where do I, get it done? So we use the parallel markets, and this is what it looks like. So this is a document that you have to upload to be able to invest in some of these with 506C investment. So people will ask, are you an accredited investor? So there's a requirement by salary by income, which is 200K by yourself or 300K with your partner, so for example, so this one, you send your documents, 2 years of tax return to this company, and then they certify you that, yes, this person is an accredited investor. So you can upload this to the portal for the operator. So that's one. You can also get it from your CPA if you're really worried about sending your information to a third party. I always say your CPA is also a third party, by the way, but at least you trust them, and they can write you a letter and said, look, you're accredited. So that's it for that.
Yeah, I use my CPA to do mine, but I have noticed a lot of operators who are doing 506C, they'll have a group that they work with, like you're working with Parallel, and they'll include that in some of the documents. So you may see this as an attachment. It doesn't mean you have to use their company. You can use any verification company, but it's one specific document that you may see, so you know what it looks like.
Okay. Since I have this, I'll let George talks about the definitions and while I scroll through this. Okay. So this is the typical PPM. At the end of the day, you could do the one sheet, you could do the slide deck, you could even reserve, but none of them is legal, right? Until you sign this document. So this is the main document. This is the legal document that binds you and this deal. So this is very important. I personally also complain about how long this document is, right? Sometimes it's like 120 pages and you don't get time to look through every single thing. But we just have few ideas of how you can comb through this, at least to be able to get enough information to make a decision, right? So,
I see we have a hand up.
yeah,
Yeah.
Question.
Yeah, I have a quick question. Hi, this is Sonia Rabon. I'm here in Los Angeles, California. I have a quick question. You said you use a CPA. Were you just saying a CPA just to verify that you are accredited? Is that correct? Is that what you meant?
Mm-hmm. Yes, they will verify your net worth or your income.
Gotcha.
And
Okay.
make a, yep.
Mm-hmm. All right. We'll just make sure I got that clear. Thank you.
Yep. Mm-hmm.
The CPA knows you, right? or hopefully, so they can write but for some people, just using the parallel market, because my CPA sometimes it'll just charge you another little bit of money for everything I do with him. So sometimes it's like $350 for the hour. So yeah, so the first one that I really think, if you don't look at anything else, you should at least look at this part of it. Of course, you see how many units, what is the minimum investment, what is the maximum investment, what kind of units. Sometimes it's the class A, class B, class C units. Sometimes they divide it based on how much you're investing. For example, the last deal, if you invest 500K and above, you're class B. If you invest 100K, it's class A. And then if you're GP, you're class C. It's bunch of classes. But the executive summary is one of my favorites. And that's the first thing I look at. So the executive summary gives you basically one sheet or two sheets of all the summary of this whole PPM. So this is usually the first thing here. So for this one, you're able to get information about the LLC, right? The company information, the sponsor. This part is important because in the deal, for example, me included, we have raised or be an investor relations with companies where my name might not show up here, right? But nevertheless, we're connected to them and we raised funds for them, right? Same thing with people that raise funds for us. Like in this deal, actually George was part of the deal, but he came in more as an investor relations. So it's just good for you to at least see if that person that's trying to get into the deal, first of all, is part of the executives or key personnel or sponsor. And if they're not, try to find some proof or at least some association, because otherwise there's a chance you might just wire your money to a scammer somewhere. So just find people's name and know that some are obvious, like George and I work all the time, right, together. So that's obvious. But if it's not obvious, ask for documents, ask for a Zoom meeting with both of them together to be sure. So company objectives, this way they might do webinar, they might tell you 3 years. What is legal is only what is here.
Right.
This is what you sign. So that I just want people to know that people can tell you anything, especially if it's not recorded. Okay, so just know that the document itself, they talk about it. This was a 506B, this particular one. So which means we could not advertise it. Just nuance to how you can advertise the deal. But 506C, you can easily, right? And everybody has to be accredited. For this one, you don't have to be accredited. So it's just good to see, make sure that they are following the rules. Let's say you find the deal on Facebook ads, and then you find out it's 506B, and you don't have enough relationship with them. They might be breaking SEC law, and the whole deal might be out of the window if the sponsor is in jail. So then, so basically just want to get that. If you have any particular question about this,
So I like to say this executive summary, this official legal document is like just a super efficient, comprehensive version of the offering memorandum. The offering memorandum is like a pretty version for the webinar, but this is the legal version with everything compacted. It's like just the facts, man. If you ever heard that quote, none of the fluff. You just want the actual information in a condensed format that you can review in 1 or 2 sheets, right? So
I have 2 more on my end, and then you can tell me more, Judge. So let's go with operating agreement.
Yeah.
Every time you make an LLC, you should always have an operating agreement. And in real estate syndication, there's going to be multiple LLC, usually. Sometimes we use 2, sometimes we use 3. So which you as a limited partner will be on this LLC here. The general partner will be on this LLC. And sometimes the management, or sometimes it's the LPGP and the property itself in a separate LLC. But you have to find a way to link everything. So operating agreement just basically just tells you what is your role in this particular LLC, right? Are you a limited partner? Are you a general partner? What's your liability, right? Is this, so you can, often, normally it shouldn't be any problem, right? If you're a limited partner, you should be able to find out that you're not basically, the general partner are basically the one standing for the loan, being the one to be operating it. But it's good to at least scan through it, and if you can read through it, it's very important.
Also, I'll add that Bio said there are layers of entities that go into a lot of these syndications. And for me, when I was doing a lot of LP deals, I almost got confused as to, number one, all these different entities and then all these different agreements. I always would ask myself, why is there a limited partner agreement? Why is there an LPA? And you'll see that as an attachment on some of the emails and these official legal documents. Like there's an operating agreement. Why do I have an LPA? The operating agreement, when you see just that OA, is usually for the actual property, the company that actually is the entity for the property, versus there's an actual separate company, an entity, an LLC for the LPs that invest into the LLC, that's the property. Same thing with the GPs. So the GPs actually have their operating agreement too. So the confusing point is when you see the word OA, there's nothing attached to it. It just says operating agreement. That's usually for the property. And then the operating agreement for the LLC is called the limited partner agreement, the LPA. So is it like a kind of a semantic thing that you have to understand. So each entity has their own operating agreement that, like Bio said, defines the roles of all the members who are involved in those entities.
And you want to, so for the operating agreement, just know what are your responsibility, right? Because if you're a limited partner, you shouldn't be saying that you're going to be managing. Sometimes it might tell you that you have a voting right. Sometimes it will say you don't have a voting right. So there's different things that if it's important to you to look at the operating agreement. Any questions about operating agreement? Another one that I have is the subscription agreement. This really itself is really what you're signing. Okay? This is really where the crux of the matter. So it's the subscription agreement. And this is where you put your EIN, the social security, the number of units you're buying, what is the capital contribution. And this is legal. So technically, once you sign this, you have to wire. But of course, no operator is going to force people to do things for that purpose. But what we ask that by the time you get to this level, you need to determine, do you absolutely want this deal or not? Okay. And don't sign until you're certain.
Yeah, this is the actual commitment to invest. All the operating agreement beforehand is just literally detailing how the business is going to run. The PPM before that literally is like an informed consent. It's going to list all the things that can go wrong, and then what happens after that. What are the recourse or the follow up if things go wrong? So that's I like making that analogy where the PPM is like an informed consent, because I know we have a lot of healthcare providers on this call. But the subscription agreement is actually you committing to that project. You're saying, I'm going to allocate X amount of capital into this property, this deal, this company.
Yeah. So some of the slide deck tends to be included, nevertheless, in there too. As you can see, they will still put in part of the slide deck, talk about each officer, about the deal, then everything's still going to be included. So they give you a very good long version of why this person is qualified to do this, why the other sponsor is qualified to do this, and an executive summary. So you have to they give you all that information also in the PPM. For me, if I already have the slide deck, I tend to skip this part. Not a financial advice, but so there's a lot of pages to read. So I go in there, I read the executive summary. Next, I find that operating agreement, try to see, make sure that what my responsibility is just to give the money. You send me my returns. At the end of 5 years, you give me what you promised or what you estimated, right? Projected. And then we shake hands and we're friends and I'm gone. And if something happens to the company, I'm not liable. So then I do that. And then the subscription agreement, I want to be sure that I'm actually the amount I'm putting is still the amount that goes into the deal. People don't do that anymore. Before, we're going to talk about fees later. Sometimes you will see that you put in 50K and then before everything is done, it's only like 40K. But everything is going to be listed there if it's going to be chipped away, if there's going to be a big upfront reduction in the money that you actually invested in. Okay, I pause there, and then we have some few more definitions.
The last form that you'll see, and let me see if I can pull up an example. I couldn't find a real life example, so I'm trying to find an image of it. But it is a bank wire transfer form. That's usually a separate document that they'll show you, where you can review just the destination you want to be. You want to look over this really carefully, where you look over like where the bank is, even call the operator, have them on the phone at this time. You're reviewing this with them. You want to make sure the routing number is correct. You want to make sure the bank account number is correct. You want to make sure you fill it out right. There's usually instructions on how to note or attention the wiring instructions. So you'll see that as a separate attachment in the email once you've signed off on your subscription agreement and signed off on the PPM, which again is like the informed consent. So that's the last form you'll see before your funds are away and now you're invested in the deal. And yes, like Bio said, there's many key terms to comb through when you look through the PPMs and the OA agreements. So we'll jump into those right now. Any questions so far?
I'm actually going to add that make sure you call to confirm, right? If they don't confirm immediately, right? And I make sure that investors within 24 hours, immediately we find it, we make sure that we send it that, oh, we got your money, right? Sometimes even a text message, because I always get anxiety until the sponsors finally message me. So if you're a GP, make sure you do that. And if you're a limited partner too, obviously, it's not a little amount of money, right? These are $50,000, $100,000, $500,000. So you make sure you confirm that it goes to the right place.
Another security measure then is you can use the operator's portal. So they'll have all these documents in a portal all in one place for you to review. So it's not just like a random email that you have to try to trust. You can set up your login to the portal. You can look at all the deals that they're having, and if it's the one you're specifically looking at and you click on it, it should have like a list of all the documents, subscription agreement, PPM, wiring instructions, verification form, all in one place, and it's a little bit more secure, but still call.
Yeah.
Oops.
Okay, so that's about it. And then we just have some questions that most people ask us about, or things that people, when they read the PPM, they call us and be like, okay, can you tell me what this is? So we're going to go over some of the key points.
Yes. So, Bio, I'll throw you one. The capital call, where does that show up in the documents and why is that important? What are we looking for with that?
So in part, yeah, so it usually shows up in the operating agreement, limited partner agreement. So it's going to talk about, basically capital call simply means, even though you have invested in this deal, if the deal is not going, we can ask for you to contribute more capital. And so that's one. Some people will also use a different, it can also be that you say, I'm going to invest 200, if it's a fund, you say, I'm going to invest 200K, and you give 100K now. So they can call for the other 100K, later. So that's usually what it is. So just have to understand what the capital call provisions are. So some will be like, you absolutely have to give the money, and it will have some ramification for it. Some will say, you don't have to give the money. We're going to get the money somewhere else, but your shares will be diluted. That's usually the most common one. And so we just wanted to understand what are the provisions, because everybody do not expect that capital call to happen, because everybody was doing well for almost more than 10 years until 2023. And then
I think it's an important one to highlight, especially considering the last year or two, there's been a bunch of capital calls. LPs, you definitely want to find that section. And like Bio said, distinguish it from the initial capital commitment versus what happens if a capital call occurs. You want to see if they spell out the different things that you could encounter. Do you have to give money? Are they going to seek third party money, outside money? You want to see language in there regarding all the circumstances surrounding a capital call event. And that should be clearly stated.
Actually, while you're doing the next one, I'm going to try to see if I can find it on mine, and then I'll see what our languages were.
Yeah. So other things you want to look for is the term preferred return. You want to see that spelled out in the operating agreement. You want to look for what that looks like. A preferred return is the amount that the operators, the GPs, are legally required to pay you first if there's the capital there before any other party gets paid. And usually it's between 6 and 8% in some of these value add multifamily deals. And that means if you invest 100K, 6,000, and there's $10,000 to be of profit to be distributed, that first 6,000, if it's a 6% preferred return, let's say, that first 6,000 has to go to the LPs first before the rest of that 4,000 gets divvied up between the LPs and the GPs. So you want to see that term if they're offering it. Most do, some don't. So you want to check number one, if it's there or not. Is there going to be a preferred return? Do you want a preferred return? Is that something that you're looking for in a deal? And then you want to see the actual numbers associated. Is it a 6%? Is it an 8%? Is there something called is it going to be carried over into the next year? Some deals have it where it's in the documents where the preferred return only counts for that year and it doesn't get carried over. So say you're owed 6%, but they only are able to give you back 5% because that's just, they only have $5,000 worth of capital to give back. Therefore, what happens to that other 1,000? Does it just vanish, or does it carry over into year 2 and now it gets added into your 6% pref return for the next year? So you want to see language on that because it could look different. Operators could spell it out differently, and so you want to know that going into your investment.
Yeah, I agree in terms of the pref. Not every deal has pref return. Everybody is so used to pref return now. Sometimes it's the return. So they'll say just 7% every year. So if they don't get that 7% that year, next, then that's over. So it's just get that 5%. And then in 2025, they try to get that 7. If they don't get, then you just keep going like that. But just make sure there's pref there, which means it's getting kept. So if they give you 5 this year, they should try to give you 9 next year to balance to the 7. And if they give you 7, then that 2 continue to carry over until the sale. So, so just something to keep in mind. So don't just assume because all the deals are like looking the same nowadays. I couldn't find the capital call out, they must have added a different name on there.
That's fine.
I'll talk about clawback provision. Clawback provision is another thing that you should basically look for because it basically allows the GP to be able to claw back the money they already distributed to you. It's not just a capital call, but let's say you have this deal, 3 nice years, you get 10% return. So you invest 100K, you got 30K. You already spend the money, and then 4th year, something happens, and they said, oh, there is a clawback provision, and then they'll try to pull it back. Now, there is also a clawback provisions. Most GP will not do it to themselves, but some GP too can have it in such a way that it will say, if we don't perform up to a certain standard, they can claw back like some things like acquisition fees. They can claw back some of the money that they already received also. But this is almost like telling the Senate to vote against themselves. But it does exist that the clawback provisions go both ways sometimes. So.
Yes. So I want to talk about something called the key person clause. So you want to look for this as well because you may have a general partnership team, 2, 3, 4, 5 people who are all doing different roles and functions to carry out the business plan. But you actually want to look in these legal documents to see if they account for what would happen if one of them or all of them become incapacitated for whatever reason. They just cannot function and carry out the business plan. Do they have some contingency plan for that? Someone who can take over the deal, or does the deal get dissolved? Like that needs to be in writing. That needs to be something that LPs need to look at and understand if that situation occurs. You want to know how to handle that. Are there voting rights for the LPs if they need to vote in someone else to take over the deal? So you absolutely want to go to the section that talks about voting rights for the LP, because even though you're a limited partner and you're not part of the day-to-day, there are different varying levels of voting rights that you can have. And in some deals, in the writing, you can literally vote out the GPs if you feel like enough the LPs feel like that they're not doing a good enough job. That could actually be written into the legal documents. So you want to know what your voting rights are for LP. You want to know what the contingency plans are if the GP is incapacitated and no longer can carry out the deal.
Yep. I'm going to also add that the key person clause is another thing to know. Like there are some deals, like George and I passed on some deals because there's the same person doing every single thing, right? So this guy, it's good to be vertically integrated, but it causes one point of failure in the business sometimes. So you have somebody that is the contractor, is the builder, is the investor relations, is the everything for the deal. and he brings everything in-house so that if something happens to him, then the deal is dead. So that's just, actually people ask me that questions a lot, especially in the beginning, because I was just by myself. And they'll be like, what happened to the deal? Something happens to you, which is a fact. So then you tell them, we have an asset management meeting. There's 4 people that shows up, right? And everybody knows what the business plan is, and they can carry out the business plan. The only bad thing is if all of you are going on a business trip together and your plane crash, then there needs to also be a provision for that. Most of the time it's going to be dissolved, obviously, and there needs to be a way to distribute the money to the investors, or another bigger team take over the deal. Yeah, it's possible also. So yeah, so just know, ask that question. That's part of, we have the 101 questions to ask the operator and the sponsors, and that's on our website. You can download it at any time. And that's part of the question you need to ask them. What happens if you become incapacitated or if you die? Straight up.
Yep. I'm going to circle back to the whole preferred return and continue from there and ask you, what about carried interest and distribution waterfalls?
Carried interest is basically the share of profits that the general partner receive after limited partner already received their preferred return. So they just want to know how this is being calculated and distributed. So I think you explained a little bit, George, early on. So I'm going to just assume only one person invests in this, right? Just to make it easy. So you invest 100K into the deal. The pref return is 7%. Okay. So you make 10K. This deal made 10K. So the GP gave you, the investor, the 7K, which is your preferred return. Now the $3,000 left is now going to be split, whatever was already decided in the beginning. So for us, it's mostly 70-30. So now you divide that 3,000, 70-30, right? So now the carried interest now with that 30% portion of it will be carried usually by the GP. They can take it, distribute it, or they can just carry it all the way until the end. But oftentimes it's been distributed. So it's just good to know, just know how it's been calculated. And when they send you report, make sure that everything is making sense. Put some effort into understanding some numbers so that you know that, it's supposed to be 70-30, but somehow all of that 3,000 disappeared. What happened to that, right? It's a question you can ask. And they can have a good answer for you that, okay, we put it in reserve, right? Which is what we normally do. We put it in reserve until, and then when we're able to give, let's say, 6% instead of 7%, then we add it, right? To at least keep the 7%, but we keep it in mind, carry it over until we can pay everything or at the end. So
Yep.
if you have any questions about any of these topics?
I think it goes back to what we're saying about how the OM and the slide deck is not your legal document. So it's nice that they'll say X, Y, and Z in the lead up, but when I want to check the legal document, I want to go to the section that says carried interest. And when I was first investing, I didn't know what carried interest meant. I knew what GP split meant. I started to learn about what waterfalls meant, but you want to go to the section that says carried interest and look and make sure those GP splits are what they say they were. If it's 70-30 after the waterfall, it should be clearly indicated. After the pref, it should be clearly indicated. And if there's a waterfall, say after that 70-30 split, if there's actually more profit to share after that additional 3K, then it goes to 50-50. You want to see that in their language where it says distribution waterfall. It took me a while as an LP to understand what waterfall meant. It just seemed like such a vague term to me. Look for those sections, make sure the numbers line up with what they say, make sure the numbers line up what they had in their their offering memorandum.
I'm actually going to add to that. The waterfall, I forgot to clarify that part. So waterfall could be so complicated sometimes, or everything is being split. It could be that it's going to be 70-30 split, until it's 15% return, for example, until you get 15% average return. Then after that, it becomes 50-50. And then after that, once you get 21%, then it becomes 30-70. So sometimes it's just, so like here, right? Yeah, very good
There's an example here. So this is in the OM, right? Non-legal document. I want to make sure I see this in their PPM, their operating agreement as well. And just to make sure it matches up, right? At initial preferred, 12%. And then after 12, it goes 20-80. Then after 15, 30-70. Then after 18, 40-60. You want to make sure that lines up with their legal documents.
This is actually quite complicated, to be honest.
Very complex. Usually it's a lot more simple than this. But essentially it's incentivizing the sponsors to get more if they deliver you a bigger preferred return. So
aligns your interest with the sponsor's interest.
Yeah. Okay.
So let me see if I got any more for you.
What about management fees?
Yes, yeah, you should always know about the fees. Usually it's listed in the PPM. They will list it clearly. And there's many fees. In fact, we make, it's not really a joke, but we talk about how you can be feed to death in real estate syndication sometimes. So there's the acquisition fees, there's the asset management fees, and then usually there's an exit fees, right? So you just want to be sure that they're in line with the industry standard. So for acquisition fee, for example, it could be anywhere from 1 to 3.5. If you're looking at it, and because it's usually hidden in most of the slide deck, they may not say it at all. It may not be listed. It has to be the PPM. Obviously, you can always ask them point blank, what are the fees associated with this syndication? So just know it's within in the range. Exit fees, usually around the same. And asset management fees, 1 to 2%. The rule of thumb that I use is all of them together should not be more than around 5% overall. So now it can be split different ways. They can be like 2% acquisition, 1 asset management, 2 exit. Some people love deals that are just more into the exit. Southbrook that we did, we have 1% for like acquisition, which is too low. But then you can end up taking 3 at the exit. In that case, that allows you to basically benefit from doing a good job, right? When you take that exit fee, you actually take it proudly. You take it proudly. Yes, we did a good job. And then asset management, but you don't want a situation where somebody's having 3.5 acquisition fees, 2.5% management fees, and 2-3% exit fee. So you're now like 8% of the deal is gone, or 10%. So just something to think about.
I just want to quickly add before we go to the question in the chat, there's semantics involved here because I've seen it different ways. That exit fee, you can also look for it in the documents as called a disposition fee. And there's also sometimes a refinance fee if that's part of the business plan as well. And then even a construction management fee, I've seen that in documents as well. So the 3 that Bio mentioned are the typical ones: acquisition, asset management, exit, or disposition. But also look out for the refinance fee in the documents and look out for a construction management fee.
Yeah, a lot of fees can be hidden, like in there, and if you don't read properly, you have half of the deal into fees. So.
Okay, we have a question. Oh, we have 2 questions. Can you talk about Class A and Class B investors in syndication? Want that one, Bio?
Yeah, it's always one of those topics. So basically, it's the return that you get, return of investment, as if it's compounded. That's the best way I can define it. And the reason why the IRR is different from the average annual return, AAR. We tend to use AAR a lot more. I can actually try to find some underwriting for you guys to see. To show.
While you look at that, I'll give my interpretation. It's just different levels of investment. So you may have a minimum investment of 50,000, and that's going to yield a certain IRR return profile or a certain equity multiple, versus you may have another class of investors that can invest a minimum of $500,000, and they get a different profile of their return. So there's one pool of money, but how you split it up in terms of returns can be different. And so you can incentivize different levels of minimum investment. And this is potentially beneficial to the operator because maybe they want a class that allows more people to get in, but then maybe they want a class that allows them to raise more efficiently. So they have this higher minimum, and they make those returns more attractive, either a higher pref instead of a 7 pref, they give them a 9 pref because they bring in 500 minimum as opposed to 50 minimum. And so there's just different ways of raising that capital. And that's why you get these different classes of investors. And so that's my understanding of that.
Yeah. Yep, the great addition. So for example, so you obviously want to know these three numbers, right? You see the cash on cash return, and then you see the IRR, and then you see the average annual return. As you can see, the average annual return is much higher, and that's because it does not take into account the time value of the money. The IRR starts counting from the day that the deal closes. So let's say you close the deal in April and you haven't got any distribution for about a year, okay? IRR would be lower because that money is assumed that if you have got that money earlier, you could have invested it into something else along the way, right? If you're getting, and also if you distribute monthly, the IRR is going to be higher than if you distribute quarterly. So it's basically the return on your investment. Usually some people will believe that this is the real way to really calculate your return because it takes into account the time that money was just lying there also. That money that you're not getting any return whatsoever on the money. And also even at the exit. George, how long did it take the last one you exited? How long did you take it to get all the money finally?
So the deal that I most recently exited actually did a cash out refi in year 1.5, like 1.8 years, and it returned 84% of the original capital just through cash flow distributions and that refinance. And then just recently exited after 4.5 years to make a annual average return of 36%. But the IRR went up because they did that refinance at almost year 2, versus if they didn't do that refinance at year 2 and they just exited at 4.5 years, the IRR would have went down compared to that. Not that it would have been low, it just would have been lower than if I got more of my original capital back sooner. So the IRR was high. I didn't calculate it specifically, but because we got that refinance event at year 2, the IRR went up. I got my money back and I was able to reinvest it into something else sooner than the 4.5 year total.
For me, being someone that's I'm not really so much, I do like cash flow, obviously, but since I have a high paying job or career, so mostly I'm more worried about when my money is going to double. So for most part, the average annual return is what I look at for most part, because I'm not even looking at the distribution sometimes, right? You look at it like 6 months, you're like, okay, I'm still getting money from them. And then calculate it, okay, it's the preferred return. So somebody that absolutely need the money to continuously to do something with it. So you can do your own calculation, either way. But they believe that is the best way to compare investment with other investments, the IRR. is far much better to say, okay, this one give 18%, this one gives 16%, to compare it apple to apples. But I also say that this is underwriting, right? As you can see, I had that spreadsheet. You can make the spreadsheet look however you like. You can change some assumption and it would change the IRR. I could distribute every month if I want the IRR to go up, right? You could give, like you said, refinance, give more early on. So just know that it's not just the IRR, just look at the nuance of the whole deal.
See a question from Temi. If those fees are added, the refi and the construction, what would be the overall percentage of the deal? Would it still be the 5% in that case that you were mentioning, Bio? Yeah, it could be higher. It should, either way, it should be clear. Thanks a lot, Trevor. Thanks for joining. It should be clear in the initial documents and the underwriting how that impacts your return or not. That should be very clearly stated. Not saying that construction fee and refinancing fee is a bad thing. It needs to be clear. That's the plan going on the outset and what impact that has on the returns you get at the LP level. So,
yeah. And don't be too fixated on the split sometimes. Like, for example, there are deals that will be 50-50 split that might be better than a deal that is 90-10 split. So it's just about the operator, what are the things that they can deliver, and even if they take all the fees, are you getting a good return? Or is it because of the fee, now your IRR is 13 or 14%? So that's just something to think about. But if they, like in George's deal, refinancing 1 year, exit, got 4% of his money back, even if they have taken 10%, he wouldn't have cared.
Right.
So sometimes it's just the operator, and also it's also how you feel about it. Do you feel like they deserve it? Do you feel like they've done such a good job to take all those fees? So, yeah, I think it's 5 o'clock already. I know we have some few more times.
But basically, this is just to showcase to you guys what we talk about when we talk to investors. We did a pilot program for a coaching program back in the summer of last year. And this is literally one of our weekly sessions. We did 8 weeks and we just went through like example of different forms just to get folks who may not see these all the time, just to get them familiar with it, have an open space to ask questions and have discussions and just grow our collective knowledge base. So I think this is the first time we've done a webinar showcasing our coaching program. But we're going to include this throughout the year. We're going to do a couple of other weeks that we offer, and we're just going to put it out on the webinar, the free webinar for folks to come and ask questions. So hopefully it was productive and valuable, but we thank you. Any other questions?
I want to say safe flight.
Yep.
Man, and I'm
in a layover.
Yeah, man. I'm gonna try to get that business lounge thing.
Yes, definitely.
Okay.
Well, thank you, everyone. We look forward to see you in 2 weeks. We'll do another webinar.
We appreciate it.
Thank you,
guys.
Thank you. Absolutely. Have a great day.
Take care.
Thank you very much.
Thank you.
Well.